Regulatory changes are coming to the Index Universal Life industry in 2023. Regulation AG-49A is about to be updated. In this video, I'm talking to Bobby Samuelson, and we're going over what are the changes for Index Universal Life, what are the potential spillovers for whole life insurance, what does that mean for you as a policyholder, somebody who's contemplating getting an IUL policy, and what does that mean for you as a life insurance agent who sells Index Universal Life. We're going to cover all of that. So if you haven't already, make sure that you subscribe to the channel, hit the bell, that way you're notified every time I launch a new video, because we're launching videos like this every single day. And so if you are in this space, I promise you there's not another channel on YouTube that's going to help you grow your business, grow your level of understanding like this one right here. So can't wait to get into this. Let's go. All right, let's pivot a little bit. Talk about, like, I read your article on the updates. You're calling it AG-49B potentially, like whatever the updates to AG-49A. I mean, I think you're like I said, I love your creativity and the way you kind of like create stories out of it all. But like, can you talk to me about like kind of like the current regulatory status and like the updates, what you kind of see happening in 2023 with updates to IUL, why it's happening, and so on and so forth?
Yeah, I mean, the quick story on it is we have these continual cycles in IUL where companies are coming out with other ways, new ways to kind of augment their illustrated performance. Regulators catch up, turn it off. Carriers come up with new ideas. Regulators catch up, turn it off. So we've been through this 3 times now. This one was pretty simple. Carriers were using non-S&P indexes with fixed interest bonuses to augment illustrated performance. And I think the key thing to know is that those strategies illustrate better and will actually perform worse in the real world. So if you have an S&P strategy at 6 and you have an engineered index at 6, but it's got a fixed interest bonus that pushes it up to 7, okay, in the real world, that 7% actually is not going to be 6. It's going to be something like 5.5 or 5.6 or something, but it illustrates at 7 because of this quirk in the model reg, or in AG-49. And so that has now been fixed with these revisions to AG-49A. That is going to be what I'm calling, AG-49B. I can't imagine they're going to call it anything different, but maybe they will. And then it's going to be implemented, and it's got a couple more votes to go through. They're kind of perfunctory votes, and it's going to be implemented in May. And at that point, the S&P strategy in the product will basically be the best illustrating strategy, and we'll kind of revert back to what the intent was for AG-49.
How is this update going to impact like all the proprietary index stuff that's happening?
Yeah, it's going to crush them. I mean, so if you're illustrating like the number one top, I call them engineered indexes, you illustrate the number one, right? Yeah. You can expect illustrated income out of that account to drop by like 50%.
Really?
Yeah. So for almost every one of those situations, the engineered index is now going to illustrate worse than the S&P because of the game. Yeah, because they were playing games with the option budgets,
which is great.
And so it's all going to unwind all this stuff. And so a lot of those strategies are just they're not going to illustrate. They're going to illustrate worse than the S&P. So the S&P will be the best illustrating option in the product post AG-49B.
That's awesome. So I gotta go here. I gotta ask you a question. I didn't prep you on this. So I've been getting a lot of comments, right? Like with people, because I mean, you know how I am. I mean, I'm pretty bold. I'm pretty out there. I'm very whole life pro. I'm very anti-IUL based on my background and experience. And you're more agnostic, right? Like you're much, I would call it, less emotional than I am about it all, right? Like I feel like I have a responsibility in a way, because like, I feel like all of the illicit sales tactics being utilized by IUL agents, right?
Yeah.
They're doing this. And I feel like, because all these regulatory updates, I feel like eventually, if they don't get their crap together, there's going to be spillover into the whole life market, right? Like it's just going to impact all regulation. And so people keep coming at me being like, Chris, why do you have to attack IUL? Why can't you just focus on your own thing? And it's like, if you don't see that there's not a divide there, that they're actually kind of meshed together, and
they are.
And like, I feel a responsibility, even though I'm like the only one who's like really taking the heat to do it, like publicly. Like what are your thoughts? Like, I guess give me a little coaching for a second. Should I back down, or should I, like, am I being absurd? Like, you know what I mean? Or are all these other people out of a line?
Yeah, look, I used to be really emotional about this too. So I'm probably the wrong person to ask, but I do think I love the idea behind IUL. I mean, the core concept of downside protection with upside potential makes a lot of sense. I mean, and there is something really powerful about that intuition.
Yeah.
And I've said this publicly, like, and that's why I'm more agnostic, is I like the idea. I think there's merit to IUL. I think there's a real story for clients. On the flip side, though, I think there's a great story for whole life too. And to me, whole life and IUL share a lot in common, because with IUL, you're getting participation in equities through options. With whole life, you're getting participation in a mutual company because you're a participating policyholder. And so they're actually the two very similar products. And so you raise a really good point about spillover, because some of the things that have happened in IUL are actually also occurring in whole life, just on a smaller scale. So for example, illustrated loan arbitrage in IUL is actually less now than what we saw last year in whole life. So this illustrated loan arbitrage issue is the same in whole life, actually worse in whole life in some ways than it is in IUL. And I think IUL, writers are right to point out the fact that the same regulations that are happening for IUL should actually happen for whole life too, in terms of illustrated loan arbitrage. Another one is outside business earnings. Outside business earnings are a big piece of the puzzle for illustrated dividends in whole life. Outside business earnings are a little bit of a gray area in terms of how they should be illustrated or not. And I could see a scenario where IUL companies say, well, wait a second, if we can't show profits from options, whole life companies shouldn't be able to show profits from outside business earnings. Because the outside business earnings are basically the equity stake in the whole life product. The options are basically the equity stake in IUL. So I think you're right that these things are going to come together. And I think that will happen. I think there's an argument to be made that the illustration model regulation needs to be rethought. And in that scenario, you're going to see a little bit more, you're going to see some of these IUL issues kind of spill over into whole life. So I will say this, I think there's merit to the product. I think it's easy to get caught up in the bad apples. And everyone likes to say there's only a couple of bad apples in IUL. No, there are a lot of bad apples in IUL.
Yeah.
And it's not, and I'll defend them for a second. It's not their fault in some ways, because IUL companies make it so easy and defend it so, passionately.
Yes.
They defend these things that are ridiculous to anyone who is not in our business. And so people, I think, kind of get caught up in it. And, and they need a dose of realism. And look, I've been doing this for 15 years, trying to put some realism in IUL. You're doing it too. And what I found is the best approach is to say, look, there is dignity and goodness in the product, but that does not mean there's not ridiculous stuff that happens on the illustrations. And I think that is certainly true for IUL, but it is also more true for whole life than sometimes we'd like to admit. And we got to make sure we're not playing illustration games on either side of the house.
Well, especially I think that falls back, when we get into that on the whole life side, that especially happens with the non-direct recognition situation.
Oh, absolutely.
Because it allows or enables that to even
occur. It empowers it. Absolutely. I mean, I'd say 95% of the games I see being played in whole life illustrations fundamentally come back to non-direct recognition. And I don't think the carriers mean for that to happen necessarily, but it just in certain economic environments, it just does.
What are your thoughts on some of the indexing options for the dividend use in like One America, for instance, has an indexing option inside of the whole life platform? Like, what are your, to me, I looked at that, and when I was talking to them over there, I was like, man, this is everything IUL should be.
Yeah. So Guardian has it, Country Financial has it, One America has it. And there may be a couple more, but those are the big three ones. Yeah, I love that idea. I think it's great. I think it's a lot of sense. But I'll also say that is another spot where all three of those companies illustrate the maximum rate on their indexed account the same way as IUL. So a lot of times I'll end up in conversations with those companies where they're saying, oh, we have agents using this rider to win competitive cases by illustrating higher rates. Well, I'm like, whoa, you cannot bash IUL illustrations and do the same thing. You have to be consistent. So I always, I speak at a lot of Guardian stuff and One America stuff. I'll get up and I'll say, look, these are not competitive illustration tools. They are real world benefits and options for clients, but they're not there just to win illustrations. So don't do that. Don't use them to win the illustration war. Run the illustration with a zero allocation to that so that you can avoid the games and sell on that basis, and then give the client the choice if they want to index their returns. Don't
then you're giving them some upside, right? You're giving them some upside potential, right? When you do it.
Right, exactly. Totally agree. And that's the way it should be done.
To really do your studying and understand what you're doing and learn how to sell it without just selling based on the numbers on an illustration. I think that's the biggest problem.
Well, and I think, look, you kind of brought it to this question you asked me that was not scripted, or you didn't prep me for, but I think one of the outcomes of that is that, if we can't get an illustration model regulation that really works,
Yep.
what we may get in the next round of illustrations may not look anything like the illustrations we have today. So imagine a scenario where for ULs, all you see is 2 or 3 years worth of a projection, and
Yeah.
then after that, you just see the policy charge schedule. That's it.
Mm.
I mean, that is a possible outcome, which would completely eliminate the ability for producers to use the illustration to sell the product.
And that would decimate IUL sales.
I hope not.
I believe it would, but
Well,
because I think it would decimate the sales field, the sales force, because there's a fraction of the people who sell IUL that are talented enough, educated enough, knowledgeable enough to actually go out and make that sale.
that's right, but they all should be.
They should be. Yeah. Oh yeah. It'll definitely elevate the
Yeah, the average will increase because the bottom falls out.
Yeah, for sure.
But I think that's right. I mean, if you're selling it the right way, you shouldn't need an illustration. And the best sellers I ever meet don't use illustrations to sell the product.
Yeah, but I talked to 2 agents that were good producers yesterday that called me that didn't even understand how IULs worked as far as the options budget, investing in options. Like they thought their money was just going right into the S&P
No.
index.
Oh my gosh, are you kidding me? Did that really happen?
Dude, 2
I
times.
thought that's the kind of stuff. That's the kind of stuff I heard 10 years ago. I would have thought everyone by now. They are obviously not subscribers to the Life Product Review.
Obviously not. That's what totally.
Obviously.
No, exactly. So, all right, well, let's move on here. Hey, Cashflow Hacker, thanks for watching. I got to tell you, this was an interesting video. There's a lot of things to contemplate in the things that Bobby and I covered there, right? Like with all the content that I do, all the training and education that I do on the Index Universal Life stuff and the whole life insurance stuff, the infinite banking stuff. There's just so much to really take into consideration about how these changes are going to impact everything, and ultimately not just the regulatory changes, but the interest rate environment changes, how that impacts whole life insurance companies, the direct recognition versus non-direct recognition conversation. All of these things, it's not that one is good or bad, it's that you have to really understand the moving parts to each one and understand how you plan to utilize the policy if you're gonna buy it. And so, the misrepresentation of a lot of these things on both ends of the pendulum, the whole life and the IUL platform. Hopefully this video was able to give you a little clarity about that. And if you want to do a deeper dive, I'm going to put the Index Universal Life training playlist right here. Check it out. And also the last video that I did with about infinite banking, and Bobby and I having a conversation about infinite banking, I would encourage you to check it out if you haven't already. Have a blessed, inspirational day, and we'll see you on the next video.